You've backtested your trading strategy thoroughly. Over 200 trades. Win rate 63%. Average risk reward 2.4 to 1. Positive expectancy confirmed. The math works. The edge is real. Monday morning, you identify a setup that perfectly meets your criteria. Every confirmation is there. This is exactly what your backtested strategy says to trade. Your hand hovers over the mouse. But you don't take it. Something inside whispers doubt. What if this is one of the losing trades? What if the backtest was just lucky? What if the edge doesn't work anymore? You pass on the trade. It goes to target. You would have made $530. You watch the entire move happen without you, and you feel sick. Not because you missed the profit, but because you had a proven edge and didn't trust it. This pattern repeats constantly. You have a strategy that works, confirmed through rigorous testing, but when real money is on the line, you can't pull the trigger. You second guess, hesitate, skip trades, or enter with such hesitation that you exit at the first sign of normal volatility. You don't have a strategy problem, you have a trust problem. And until you understand why your brain refuses to trust mathematical edge and how to build genuine trust rather than false confidence, you'll keep sabotaging your own proven strategy through doubt and hesitation.
The psychology of edge trust. Here's what's actually happening when you can't trust your edge, and why having a winning strategy doesn't automatically create the psychological ability to execute it. Trust, in psychological terms, is the belief that a system will produce expected outcomes with acceptable consistency. When you trust your car's brakes, you believe that pressing the pedal will stop the car predictably. When you trust a person, you believe their behavior will be consistent with their character. But trading edge operates on probabilities, not certainties. Your edge says, this setup has a 63% chance of working. Your brain hears, this setup has a 37% chance of losing me money. These are mathematically equivalent statements, but psychologically, they create completely different responses. Psychological reality 1. Brains trust certainty, not probability. Your brain evolved in environments where outcomes were largely deterministic. If you see a predator, you run. If you find food, you eat. The outcome follows predictably from the action. Your neural systems are wired to trust deterministic cause and effect relationships. Trading edge is probabilistic. Same setup, same execution, different outcomes. Your brain struggles to trust probabilistic systems because probability doesn't feel like reliability. A 63% win rate means frequent losses mixed with wins. Your brain interprets these losses as evidence the system is unreliable, even though they're proof the system is working exactly as the probability dictates. Psychological reality 2. Single trial experience overrides statistical understanding. Intellectually, you understand that your edge plays out over hundreds of trades, but experientially, you live each trade individually. When you take a trade and it loses, you don't experience one data point in a probabilistic system. You experience loss, pain, regret, and doubt. Your intellectual understanding of edge exists in your prefrontal cortex. Your experiential reaction to losses exists in your limbic system. The limbic system is faster, stronger, and more emotionally compelling. It overrides your statistical understanding with immediate experiential doubt. Psychological reality 3. Trust requires emotional evidence, not just mathematical proof. You've proven your edge mathematically through backtesting, but your emotional brain doesn't process mathematical proof. It processes lived experience. To your emotional brain, the backtest is abstract data. Only real money trading provides emotional evidence. This creates a cruel paradox. You need to trust your edge to execute it properly, but you can only build trust by executing it and experiencing the results. You're trying to trust something you haven't emotionally experienced, while your inability to trust prevents you from getting the experience that would build trust. Psychological reality 4. Past trading trauma creates trust damage.
If you've previously trusted a strategy that failed, or trusted your analysis and lost significantly, or trusted a mentor whose advice destroyed your account, you've experienced trust violation. This creates psychological scarring that makes trusting any edge difficult. Your brain generalizes from past trust violations. It doesn't distinguish between "that strategy was flawed" and "all strategies are unreliable." The trauma of past trust betrayal makes your brain hypervigilant about trusting any trading edge, even when current mathematical evidence supports it.
The 5 trust obstacles that block edge execution. Different psychological barriers prevent traders from trusting their edge. Obstacle 1. The certainty addiction. You want certainty that this specific trade will work. Your edge provides probability that trades like this work 63% of the time. Your brain rejects probability and craves certainty, creating perpetual hesitation. This certainty addiction makes every trade feel insufficient. No matter how well the setup meets your criteria, your brain asks, "But are you certain this one will work?" Since you can never be certain, you can never fully trust the entry. Your internal dialogue: the setup looks good, but how do I know this specific trade won't be one of the 37% that fails? I need more confirmation. I need more certainty. Obstacle 2. The recency result bias. Your trust in your edge fluctuates based on recent results rather than long-term statistics. After 3 winning trades, your trust is high. After 3 losing trades, your trust collapses. But your edge hasn't changed. Only your recent experience changed. This recency bias means you trust your edge most when you need it least, after wins, and trust it least when you need it most, after losses. Your trust is inverse to where it should be. Your internal dialogue: the last 2 trades failed. Maybe the edge isn't working anymore. Maybe market conditions changed. I should wait and see more evidence before trusting it again. Obstacle 3. The backtest disconnect. You trust your backtest results intellectually, but experience an emotional disconnect between historical data and current reality. Your backtest shows 200 winning trades, but that was then. This trade is now. Your brain doesn't emotionally connect the current opportunity to the historical pattern. This disconnect makes your backtest feel irrelevant when you're staring at a real setup requiring real money. The proven edge feels theoretical, while the risk feels concrete. Your internal dialogue: the backtest worked, but that was historical data. This is real money right now. Market conditions might be different. The backtest can't predict this specific trade. Obstacle 4. The loss catastrophization. You intellectually accept that 37% of trades will lose, but emotionally you catastrophize each potential loss. Your brain imagines worst-case scenarios. What if I hit 5 losses in a row? What if this is the start of a massive drawdown? What if the edge only worked in the backtest period? Your internal dialogue: if I take this trade and it loses, that's 2 losses in a row. What if I'm entering a losing streak? I've read about traders who had 10 losing trades in a row. What if that happens to me? Obstacle 5. The identity proof burden. You unconsciously need every trade to prove your competence as a trader. If the trade wins, it validates you're skilled. If it loses, it suggests you're not good enough. This identity burden makes trusting probabilistic edge psychologically impossible. You can't fully commit to trades whose outcome might invalidate your identity. Your hesitation isn't about the trade, it's about protecting yourself from identity-threatening information. Your internal dialogue: if I take this trade with full conviction and it fails, what does that say about me as a trader? Maybe I should take it with reduced size so if it fails, it doesn't mean as much.
Meet Yale, the trader with proven edge and zero trust. Yale had been trading for 8 years when he finally confronted his trust problem. He wasn't a beginner. He had developed and thoroughly backtested a breakout strategy with legitimate statistical edge. His backtest results over 300 historical trades. Win rate, 64%. Average win, $420. Average loss, $160. Risk-reward ratio, 2.6 to 1. Expectancy, plus $196 per trade. Expected annual return, 34%. The edge was real, proven, robust. Yale knew this intellectually, but when it came to executing the strategy with real money, Yale's trust completely collapsed. Over 6 months of live trading, Yale identified 73 setups that perfectly met his strategy criteria. These were the exact setups his backtest said to trade. Of those 73 setups, Yale took only 28. He passed on 45 setups due to hesitation, doubt, or fear. The results were devastating. 28 trades Yale took with hesitation and doubt. Win rate, 57%, below backtest. Average win, $310, below backtest, likely from early exits. Risk-reward ratio, 2.6 to 1. Net result, plus $2,540. 45 trades Yale skipped, tracked in journal. These setups went on to hit target or stop without him. Based on his backtest probabilities, these would have produced approximately 29 wins and 16 losses. Estimated foregone profit, $7,628. Yale had a proven edge that should have made him approximately $10,168 over 6 months. Instead, he made $2,540 because he couldn't trust his edge enough to execute it consistently. His lack of trust cost him $7,628 in missed opportunities. More painfully, the 28 trades Yale did take, he took with such doubt and hesitation that he managed them poorly, exiting winners early and letting losers run, further degrading his results below what the strategy was designed to produce.
Inside Yale's mind, the trust collapse sequence. Yale documented his internal dialogue during a typical trust failure episode to understand the exact psychological sequence. The setup recognition, intellectual confirmation. Thursday, 11:20 a.m. Yale identified a breakout setup on a stock he'd been watching. He ran through his checklist methodically. Price breaking above resistance. Check. Volume exceeding 1.5x average. Check. Trend alignment on higher time frame. Check. Risk-reward ratio exceeding 2.5 to 1. Check. All technical confirmations present. Check. His intellectual analysis concluded, this is a perfect setup. This is exactly what my strategy identifies as high probability. My backtest shows 64% win rate on setups exactly like this. Entry at $43.20, stop at $42.70, target at $44.90. This meets all criteria. Yale knew he should take this trade. The logic was clear, the edge was proven. But as Yale's hand moved toward his keyboard to execute, doubt flooded in. Wait, what if this is one of the 36% that fails? Your last trade 2 days ago failed. What if you're entering a losing streak? The market's been choppy lately. Maybe the edge doesn't work in these conditions. Yale's rational brain tried to counter. The edge is probabilistic. Some trades will fail. That's expected and built into the positive expectancy. The market being choppy doesn't invalidate the pattern. The backtest included all types of market conditions. But emotional doubt grew stronger. But your backtest was historical. That was the past. This is now. Things change. What if the market dynamics have shifted? What if this pattern doesn't work anymore? You don't really know this will work. Analysis paralysis. Searching for certainty. Yale started overanalyzing, searching for additional confirmation that would give him certainty before he could trust entering. Let me check one more indicator. Let me look at the 15-minute chart. Let me see what the broader market is doing. Let me check if there's any news. Let me verify the volume calculation again. This wasn't analytical rigor.
This was doubt searching for certainty that doesn't exist in probabilistic systems. Yale was trying to convert a 64% probability into 100% certainty before he could trust entering. The opportunity window closes. While Yale overanalyzed, the breakout continued. Price moved to $43.60. His planned entry at $43.20 was gone. The risk-reward ratio had deteriorated from 2.5 to 1 to 1.7 to 1. Now Yale faced a new doubt. I missed the entry. Should I chase it? But that's not following my plan. Or should I wait for a pullback? But what if it doesn't pull back? What if this runs to target without me? Yale's trust problem had created an execution problem. By the time he finished doubting, the opportunity had passed. The painful observation. Yale didn't take the trade. Over the next 4 hours, he watched the price move exactly as his strategy predicted. It hit his target at $44.90. He would have made $510. Yale's internal dialogue watching it happen, there it is, perfect execution of the pattern, exactly what my backtest said would happen. I had the edge, I had the setup, I knew it met my criteria, but I couldn't trust it. I let doubt prevent me from executing proven edge. The cruel irony was watching the trade work without him didn't build trust. It reinforced regret and self-doubt. I can't even execute my own strategy. What's wrong with me? I have the edge and I still can't trust it. Maybe I'm just not cut out for this. This experience made trusting the next setup even harder because Yale had added another failure to his psychological record. Not the failure of the strategy, but the failure of his ability to trust and execute it.
The anatomy of trust destruction in trading. Yale analyzed his pattern and identified exactly how lack of trust destroyed his trading performance. Destruction pattern 1. Execution inconsistency. Without trust in his edge, Yale's execution was wildly inconsistent. He took some setups but not others, with no clear pattern except that he took setups when he felt confident, often after recent wins, and skipped setups when he felt doubtful, often after recent losses. This inconsistency meant Yale was never actually trading his strategy. He was trading a random subset of his strategy's signals filtered through his emotional state. This destroyed his edge because probabilistic edge requires consistent execution across all signals. Destruction pattern 2. Selective execution bias. Yale noticed he was most likely to skip setups during drawdown periods when his trust was lowest. But statistically, winning trades after losses are just as probable as winning trades after wins. His selective execution was removing random trades from his sample, degrading overall results. Worse, by skipping trades during low confidence periods, Yale was guaranteeing his equity curve remained flat during those periods, reinforcing his perception that things aren't working, which further damaged his trust. His lack of trust was creating the unreliable results that justified his lack of trust. Destruction pattern 4. Opportunity cost accumulation. The 45 trades Yale skipped represented $7,628 in foregone profit, but the damage was deeper. Each skipped trade was a lost data point that could have built trust through experience. Yale was avoiding the very experiences that would have built the trust he needed. This created a stagnation loop. No trust, no execution, no experience, no trust building, continued no trust. Destruction pattern 5. Strategy abandonment risk. The most dangerous aspect was that Yale's inability to trust his current strategy made him constantly search for a better strategy he could trust more easily. He researched new approaches, considered different time frames, explored alternative methods. This strategy hopping prevented Yale from ever accumulating enough experience with any single edge to build genuine trust. He was caught in a cycle: develop strategy, can't trust it, search for new strategy, can't trust that either, continue searching. Yale's transformation, building genuine edge trust. Everything changed when Yale stopped trying to feel confident about individual trades and started building systematic trust through structured experience accumulation. System 1. Paper trading with emotional tracking. Yale's first step seemed counterintuitive. He returned to paper trading, but with a specific purpose. He wasn't testing the strategy, already proven. He was training his emotional system to experience the probabilistic nature of edge. For 60 consecutive paper trades, Yale executed every single setup his strategy identified, without exception. He tracked not just results, but his emotional response to each trade. This created experiential data his emotional brain could process. He experienced 5 trade losing streaks followed by winning streaks. He watched edge play out across various market conditions. He felt the emotional roller coaster, but without financial consequences. He saw 62% win rate manifest in real time. This emotional exposure to probabilistic outcomes built trust more effectively than reviewing backtest spreadsheets. System 2. Micro-position trust building. When Yale returned to real money, he started with position sizes so small they were almost meaningless, $25 risk per trade instead of his planned $150. At this size, losses created minimal emotional disturbance. Yale executed 30 consecutive micro trades following his strategy perfectly. This accomplished 2 things. He proved to himself he could execute the strategy consistently. He accumulated real money experience without emotional overwhelm. As his execution consistency reached 90% across these 30 trades, he gradually increased position size, $50, then $75, then $100, finally reaching $150 after 80 total trades of consistent execution. System 3. Trust building through evidence accumulation. Yale created a visual trust building tool, a live execution tracker. After each trade, he logged trade number, X of 100, outcome, win/loss, running win rate, X%, running expectancy, X dollars per trade, edge still valid, yes/no, based on statistical significance. Watching this data accumulate in real time provided emotional evidence that his edge was real. After 40 trades showing 62.5% win rate and positive expectancy, Yale's emotional brain had evidence to match his intellectual understanding. System 4. Pre-trade trust affirmations. Before each trade, Yale implemented a trust-building ritual. He read aloud, "This trade is one trial in a probabilistic system. I don't know if this trade will win. I know that trades like this win 64% of the time over large samples. My edge doesn't require this trade to work. My edge requires me to take all trades that meet my criteria. I trust the process, not individual outcomes." System 6. Doubt Acknowledgement Protocol. When doubt arose, he wrote, "I'm feeling doubt about this trade. This doubt is normal and expected. Doubt doesn't indicate the trade is bad, it indicates I'm risking real money, which creates emotional discomfort. The trade still meets all criteria. I acknowledge the doubt and execute anyway." This protocol separated feeling doubt from acting on doubt. Yale could feel uncertain and still execute. The trust wasn't in perfect confidence. The trust was in following his process despite imperfect confidence. System 6. Loss Normalization System. Yale created a visual loss expectation chart. Based on 64% win rate, he expected 36 losses across 100 trades. He created a physical chart with 100 boxes. After each loss, he marked one box. This visualization made losses feel like progress toward completing the expected distribution rather than failures. That's loss 7 of expected 36, normal, on track. This normalized losses psychologically, preventing them from damaging trust.
The breakthrough realization. After 4 months of systematic trust building, Yale was analyzing a setup. He felt the familiar doubt beginning to arise. What if this fails? But then Yale had a profound insight. This question is meaningless. Of course this might fail. 36% of my trades are supposed to fail. The question isn't, what if this fails? The question is, does this meet my criteria? If yes, I take it. The outcome of this individual trade is irrelevant to whether I should trust my edge. The only thing that builds trust is consistent execution across sufficient samples. Every trade I take with discipline, regardless of outcome, builds trust. Every trade I skip due to doubt erodes trust. Yale took the trade. It lost, and he felt genuinely fine about it because it was loss 14 of his expected 36. He was on track. His trust wasn't damaged because his trust wasn't based on this trade working. It was based on his process working over time.
Yale's results, the transformation in numbers. The changes in Yale's results after implementing systematic trust building were remarkable. Before trust systems, setup identification, 73 valid setups. Trades executed, 28, 38% execution rate. Foregone opportunities, 45 setups. Actual profit, $2,540. Expected profit, if fully executed, around $10,168. Trust-based cost, $7,628 in missed profit. After trust systems, setup identification, 81 valid setups. Trades executed, 77, 95% execution rate. Win rate, 63%, matching backtest. Actual profit, $9,347 over 6 months. Execution consistency, 95%. Trust rating, self-assessed 1 to 10, improved from 3 to 8. Same markets, same strategy. The only difference was that Yale built genuine trust in his edge through systematic experiential evidence accumulation, allowing him to execute his proven strategy consistently. How to build trust in your edge. Your action plan. If you recognize this pattern in your trading, here's your systematic approach. Step 1. Verify your edge exists. Before building trust, confirm your edge is real. Backtest rigorously over minimum 100 trades, preferably 200 plus. Calculate win rate, average win/loss, expectancy, maximum drawdown. If the math doesn't show positive expectancy, you can't build trust because there's nothing to trust. Step 2. Document current execution rate. Track the next 50 setups your strategy identifies. How many do you actually take? Calculate your execution rate. If it's below 80%, you have a trust problem, not a strategy problem. Step 3. Implement paper trading exposure. Execute 50 to 100 paper trades following your strategy perfectly. Track emotional responses, not just outcomes. Your goal is emotional exposure to probabilistic distribution, experiencing losing streaks and winning streaks without financial consequence. Step 4. Begin micro-position real money. Start real money trading at 10 to 20% of your planned position size. This size should create minimal emotional disturbance. Execute 30 consecutive trades with perfect adherence to your strategy. Focus on execution consistency, not profit. Step 5. Build live evidence tracker. Create a visual tracker showing trades completed, running win rate, running expectancy, statistical significance. Update after every trade. Let accumulated evidence build emotional trust. Step 6. Create pre-trade trust rituals. Write affirmations that separate individual trade outcomes from edge trust. I trust the process over large samples. This trade is one trial. I execute all signals regardless of individual uncertainty. Step 8. Normalize expected losses. Based on your win rate, calculate expected losses across 100 trades. Create visual representation. Mark losses as they occur, framing them as completing the expected distribution rather than failures. Step 9. Gradually scale position size. Only increase position size after demonstrating 85% plus execution consistency at current size across minimum 20 trades. Scale gradually, 20%, 40%, 60%, 80% of target size over time.
The fundamental truth about trust and edge. Here's what Yale ultimately learned. Trust in probabilistic edge cannot be created through intellectual understanding alone. Mathematical proof is necessary, but insufficient. Trust requires emotional evidence, and emotional evidence only comes through lived experience. You cannot think your way into trusting your edge. You must experience your way into it. This means executing your strategy consistently across sufficient samples to emotionally witness the edge manifest in reality, not just in backtests. The paradox is real. You need trust to execute consistently, but you need consistent execution to build trust. The solution is systematic. Start with emotional exposure through paper trading, progress to micro-position real money, accumulate evidence through consistent execution, and gradually scale as trust builds through experience. Stop searching for the perfect strategy you'll automatically trust. Start building trust in your current proven edge through systematic experiential accumulation. Stop trying to feel certain about individual trades. Start building trust in your process across many trades. Your hesitation isn't weakness, it's your emotional brain lacking the experiential evidence it needs to trust probability. Give it that evidence through patient, systematic, consistent execution at appropriately scaled risk. Trust isn't something you have or don't have. Trust is something you build deliberately through structured experience accumulation. Build it systematically, and your proven edge will finally translate into consistent profits.